Hey y'all, it's late night Sunday. We're dropping another episode of Coronavirus SOS. My God, there's carnage out there. Oil gets sunk. So basically, the band of merry oil thieves, OPEC plus Russia, have decided to disband. And Saudis just said, hey, listen, we're just going to pump as many barrels onto the market. There you go. So what carnage it has left. So last check here, we got oil at WTI at $30.60, down a whopping 26% from Friday. Amazing. Those are futures right now. We got the U.S. market set to open to carnage on Monday, down 4 to 5%. It's ugly out there. Basically, this is now, we move beyond coronavirus, passing crisis, a couple hospital beds, and we move on to now, when oil sinks this hard, you say the R word, recession. And this is when everything starts to dump. People start to panic. We're going to walk you guys through the whole dynamic here. Bottom line is, the market ain't going to get better before, it's going to get a whole lot worse. There's no question about that in terms of the panic, just sheer panic right now in the market. We've got 10-year treasuries, 0.5%. Again, this is rough stuff. So anyway, that's the price on oil. It's going down. We'll see where we stand on Monday morning, but this ain't good right now. Now, I tweeted some knowledge. A lot of folks out on Twitter who trade left, right, but don't know exactly how the price of oil is set. Let me school everybody, show what's going on. You just can't draw lines on a graph. You got to understand what's underlying the graph in terms of what drives the fundamental supply-demand on oil. This is critical stuff. You got to see it. This is from Bernstein. Basically, this is how oil prices are set. We've got a bunch of graphs here, a bunch of lines here. The Brent crude is just, that's the price of oil. But this is how you should think about it. The middle line there, that's the marginal cost of supply of producing a barrel of oil. So when things are hunky-dory, life's kind of middle of the road, good, economy's chugging along, that's where things kind of stand. So the price of oil effectively should clear at what cost it takes to bring a marginal barrel online. When things get bad, i.e. now, when you're flooded with supply, there isn't demand, here we sit, where we go is estimated marginal cost, cash cost. And what that means, so the first cost that I mentioned was all in marginal cost of supply. So that's the cost it costs for me to build a new shale oil well, taking into account all of the different costs. But when you go into cash cost mode, you're just saying, listen, what does it cost for me just to keep the spigot on, just to create that new barrel? Because that's what effectively goes down to. And you're looking at a bottom of, surprise, surprise, $20 to $30 per barrel. So could it get worse from here? Hell yeah. There are, Saudi can probably produce for, call it $5 or $6 per barrel at, just cash cost. So what we're saying here is that definitely this could get a whole lot worse in terms of the here and now. Are we in a way oversold levels? Yeah. But listen, we're talking the R word, recession. You don't stand in front of a freight train. And that's what it is right now. Now, so that's on the energy side, because it is the oil is sunk SOS coronavirus episode. Now we need to go to the coronavirus. Another important graph that I tweeted out over the weekend. This is how you should look at it. The market hasn't digested what this is about. So basically what everyone needs to understand is this, obviously the market underestimated what this meant, how quickly this would go global specifically, and just seeing how the U.S. is recoiling. But social distancing, this is the key word here. This will become a more important phrase as the U.S. and other countries globally start to think, listen, there's a problem with the coronavirus here in the sense, in the view that basically a disproportionate amount of people who get this end up in hospital beds, needing respirators, etc., jamming up intensive care units. So the real issue and problem that the governments need to understand is how do we ensure the caseloads that show up at hospitals remain at a level which doesn't overwhelm the hospital system. So here is a graph showing basically if you were just to let it run wild, okay, listen, everyone go to their, go to South by Southwest, go to any big gathering. Let's just get this through the population and be done with it. No, this is why that doesn't work out. The dotted line across is healthcare systems capacity, beds, ER visits, etc. You don't want to go above that line. So that first hump is if you were to just let this thing run wild. You start to blow away your capacity at the hospitals. Now, if you were to then say, listen, let's have proactive measures, slow the disease, the spread of the disease, the same amount of population will potentially could get it, but let's slow the spread and ensure that the hospitals can manage this, which effectively is social distancing. Don't go to the office, don't go to South by Southwest, don't go to the Winter Music Conference in Miami, etc., etc. That is when you have a fighting chance of the hospital system beginning to go. Now, the market hasn't digested. This is a big bloody hit on the economy, and that's what needs to be digested over the coming weeks. The next chart is phenomenal. Found this on Twitter. This guy put this out there, which is it puts the pandemic situation in Italy in focus. So what it's showing here is the rate of intensive care cases, right? And basically, it's as close to exponential as you get. And what this shows here is if this follows this line, and every dot has just been following this exponential line, phenomenal fit. An R squared for the math nerds out there of 96, so 0.96, that's very, very high. So if this line continues over the next 2 weeks, you're looking at a healthcare system in Italy that potentially collapses. That's why the coronavirus, and this is a flu. So that's why economically this is a disaster. That's why a third of Italy's being told to don't do anything, stay at home. Now, let's get back to the market. There is a very interesting table put forth by Morgan Stanley, but effectively answering the question is the Fed and Powell, oh man, you can't even say Powell's such a weak man. Dude, you're cutting rates last year. You should have never been cutting rates last year. There was no need. And now you're panicked. You cut 50 basis points last week. Let's see what this actually does. So Morgan Stanley ran the numbers of previous quote-unquote emergency rate cuts. So anywhere between 25 basis points all the way to 75 basis points, 50 basis points. Again, these are emergency, economy's in trouble, SOS type things. So let's look 12 months out. That really should judge the efficacy of these, emergency type measures. Save the system for the rich. So, and rich people on the market. So effectively, if you're looking out 12 months, all of these observations, basically you only 25% of the time, two out of the observations here, 25% in total, did the market actually go up? The rest of the market was down on a 12-month view. So again, these things, especially these emergency rate cuts, they just may not have the firepower to even, to see. It's way too late. So bottom line is everyone hoping that 50 basis points could help? Nuh-uh. Now, let's look at the valuation of the market. So that's telling you historically these 50-point basis cuts haven't done a hell of a lot. 75% of the time, looking out 12 months. Now, let's look at it on a Shiller PE. And this Shiller PE just tries to take out the noise. The market right now is trading at 28 times, 28.2 times to be exact. Historically, the average Shiller PE is 16.7 times. So, if the market needed to find a reason to say, oh hey, we're overvalued, on a Shiller PE basis, taking into account the economic cycle, yeah, you have a reason. Now, let's let's look more lovey-dovey forward PE, forward price to earnings ratio. This is based on estimates from the street, which are all going to be wrong. Let's look at that. So right now, we're looking, effectively, we're looking at the S&P 500 trading at 16.6 times. All right. Now we need to compare that to, let's call it the 5-year average, 10-year average, and 35-year, just to get framework here. So the forward PE over the last 5 years was 16 times, so we're rich on that basis. Over a 10-year period, the average PE, forward PE ratio was 15 times, again, rich again. And over a 35-year period, it was 14 times. So we're rich on all these measures. And now the important thing here is going back to the graph, is to look at, well, where did we bottom out at in the last recession, 09? We went below 10 times. So there are a lot of reasons for market participants who've had a phenomenal ride for the last 10 years to say, I'm going to take a little bit off the table. They probably should. Now, let's talk stocks, ideas, picks. We told you from the start of the year, gold was the asset to own. I said specifically it would be gold over oil. Nail that to a T. Grizzle gets these big calls. Now, pull up this graph, gold versus gold miners. Now, this has been a little more challenge here, where effectively we've seen gold miners lag gold. So gold's been up 10.25% year to date. So that's very good. It has acted as the hedge as it should. Now, GDX, which is the ETF for gold miners, larger gold miners, it's up 40 basis points, so 0.4%. Not so great. And GDXJ, which is the junior miners, is down 5%. So the way this should work is gold is their input, and they have costs, operational costs, debt, and they have financial leverage as well. The point is, as the price of what you're selling goes up, your margins go up. So wherever the gold price is, the way it should work is the net economic financial impact for these gold miners should be a multiple. So gold miners should be up higher than gold. We haven't seen that yet, but rest assured, last year was the first year we saw gold miners outperform gold. And again, we believe that will be the case this year as well. Again, I think there's a lot of, the market is still digesting some of the challenges, say, how these stocks should trade. But again, we feel if you look further out, especially the names we like that have G7 exposure as opposed to emerging market exposure, I think these should be well positioned. But gold miners, I think, are interesting here. But again, some combination of gold and gold miners should protect you in some way or form. But the market dynamics are not looking good in terms of the S&P 500 global markets in general. Now, here's where I think things get very interesting for those who want to get move further at the risk curve, things to short, because we are talking about the R word, recession. When oil is down this much, there's no other word to talk about. What was being pushed ahead a couple weeks ago was this whole idea, hey guys, this coronavirus, everyone's going to stay at home. Let's go long the stay-at-home basket. Last week when I was on here with Scott, we said, listen, what's going to crack if this keeps going is what was in vogue a couple weeks ago is not going to be so hot now. Because you're talking recession. Nothing really stands a nuclear blast. So I'm going to pull up this graph here. What it looks at is the S&P 500. So that's the lower line. Down since effectively the crisis took off February 20th. It's down 12%. Amazon is down about the same 12%. Peloton is only down 7%. Netflix is down 4%. And Zoom, look at that, up 8.6%. So if I were to look for that next leg of shorts, I'm like, people aren't getting to work. There's productivity simply being lost. Get off your Zoom, get on your FaceTime, cut these costs right now. And that's what we're looking, I think things can accelerate very quickly. So when I think, this is a very interesting short basket. If you put that whole on, you can buy puts for Amazon. Again, Amazon is a place to buy stuff. You can buy stuff if you have money. People are out there shopping. but everyone is socially distancing themselves. Not a lot other than toilet paper, which is bizarre. God, people crazy, loco. Again, you know, people aren't going to be buying things except for weird ass shit like toilet paper and stuff like that. But again, these stocks are now what was considered the safe basket is now the exposed basket. Final pair trade to put on. It's ugly for oil. Obviously, things down 25%. Monkey hammered here. Boom, boom, boom. We told you, stupid. Only stupid folks. And energy folks are some of the dumbest in the world. I'm that dumb. They can only see the world in one way. They rely on these dummy states to bail them out with their OPEC. Well, hey, there you go. Saudi just pushed it all on the market. So here's a short long. This is a graph from the last crisis point looking at to today. So since 2009, it's been ugly for both Canadian energy stocks and U.S. energy stocks. Basically, effectively down the same, 50%. But going forward, the play here, if you were to put a short long, I would go long U.S. energy, the shale guys, and short the Canadian guys. For the simple reason, Canadian oil is far more expensive. It's not a debatable issue. It's a bloody fact. So if the stocks are down a ton, I'm not going to go, and Monday it's going to be a massacre. You're not going to get that downtick. But what you could put on that could be very interesting is to put on a short long of these two. Again, it's Coronavirus SOS. We're doing it for y'all. Boom!